Thanks so much for tuning into this conversation with Syrma SGS. The EMS space has had cases of companies not having the revenue growth being good, but the margin growth being very strong. In Syrma's case, this quarter around, the reverse has happened. The revenue growth at 52% was well ahead and well and truly ahead of estimates. Margins, though, came off a little bit. Mr. JS Gujral joins in to talk about the quarter and the outlook ahead. Mr. Gujral, good having you. Thanks for joining in. Let's start with the top line performance, sir. 52% ahead of estimates. Two, three verticals working well, a couple of them not. Sum up the quarter for us.
In the EMS space, on the revenue growth, we are very bullish, and we expect this trend to only continue and not de-accelerate at all. Typically, H1 is a comparatively muted period compared to the complete year. It accounts for about 45% of our revenues, typically historically. So we expect this growth momentum to be sustained in the coming quarters. It has been led by consumer. Auto continues to be about 24% of our revenue, and industrial also at about 27% of our revenue. What has marginally gone down is the IT space, and that typically is because the IT policy, the PLI policy is in the works, and the clients are sort of holding back, tying up with the potential contract manufacturers till the policy comes out in the open and they know who are the approved PLI manufacturers. Healthcare in Q2 has seen a good rebound. We were about 15 crores in the Q1, and it is touching close to 40 crores, 35 to 40 crores this quarter. And this trend is expected to continue. It will be strengthened by the Johri Digital acquisition, which we completed it in the month of September. So the full impact of those revenues will come in the coming quarters.
Okay.
Now, on the margin profile, what we as sort of entrepreneurs and the business drivers look at is that is my gross material margin intact segment-wise, or is showing an improvement or a decline? And fortunately for us, and it's a satisfying thing, that within the verticals which we service, for example, automotive, we have seen an expansion of the margin by a couple of points. Industrial is almost there, some 0.5% up. Consumer has seen a significant dip. Now, in totality, for a third person, consumer has shown a dip. But when we deep dive into the consumer has two segments. One is my own design segment, and one is a contract manufactured segment.
Sure.
Now, the growth in the consumer has been led by the plain vanilla build to print. So there would be a 10%, 15% margin difference between a build to print product and an ODM product in the consumer space.
Sure.
And hence the contraction in the gross material margin. Operating overheads wise, we have gone off better. We have saved about 4.5% compared to last year, half year. And one thing which we should not forget, that this quarter has certain one-time charge-off expenses, like the expenses which we incurred on Johri Digital acquisition and other things, which accounts for about 4.5 crores. Now, if this one-off nature expenses are taken off, the operational EBITDA would be at a 8% plus. Currently, it's at about 6.9 or 7%.
Right.
So these are the Jersey. We did the due diligence, the Johri Digital acquisition, the legal cost, all those things, and other one-off expenses, write-offs relating to some previous years' settlements and all that. So if we were to harmonize it for the current quarter, the EBITDA would be better. But in the financial, yes, it is at about 6.9%.
So are you saying, Mr. Gujral, that this was a one-off only pertaining to the September quarter, the October, November, December quarter, or the second half?
This has been charged off. This has been charged off in this quarter rather than being sort of carried forward and charged off for 2, 3, 4 quarters. We are charged off in September.
Okay. And which is why you're guiding toward a double-digit margin for the...
No, I'm saying on a consistent basis, we should be there about. You see, what happens is that Neeraj, when we are expanding at a rate of 52%, so you have to keep the capacities ready for the customer. Now, when you keep capacities ready for the customer, you need to have manpower trained. So we carry in a normal growth of 10-15%, the bench strength in the manufacturing industry is almost nil, unlike in the software industry. But when we are growing at about 52 odd percent, the new factories which you put in, they may have a bench strength of 30%.
Sure,
People
sure.
being trained on the machines, but output not being delivered, and it's being charged off.
Okay. So, but you hope that you could be in this early double digits,
We could be there about double digit in the long run, which is 24, 25 onwards, which will be aided. I'll be very clearly, I think, uptake in the healthcare business, export revenues coming up the stream. As a percentage, they will still be sub 30 because the domestic is growing at 70%. The export, which currently is growing at about 12 odd percent, would see a uptick in the coming quarters because the clients which we onboarded in January, February, March, and this year, 7-8 global clients, the prototyping and the sampling is going on. The series production will start somewhere in Q1 of 24, or we can say Q4 of FY 23-24. So 24-25 will see the full impact of the revenues coming from these new global clients which have been onboarded. Third factor, which will be very critical in our margin equation, is the contribution of our design and development center, which we have set up in April of this year. So we have a 100% subsidiary, design and engineering services subsidiary. We have hired senior people in the US. So these expenses are all coming off. And I think their output, it's currently just 7 months old. It's work in progress. They're taking their first baby steps. I think the full impact of their contribution on design and engineering services as a revenue stream or design engineering services contribution to the ODM development will be fully visible in FY 24-25.
So you're saying it'll do both? It's a cost center and a revenue center both.
At the end of the day, if a guy wants me to design some, give him services for designing some product, I can do that. So I'm not being very sacrosanct. No, it will be only this, only that. So we have to grow. And I believe this revenue stream in the long run should be a significant contributor or a mainstay for growing my ODM revenue and margin equation.
Okay. So size-wise, it may not be very large, but it will play a critical part in both margins as well as.
End of the day, just as a context, if I can get 30 crores of revenue stream, these typically they have a 30-40% EBITDA margin. So I get 18 crore EBITDA increment just as a reference point, not saying that I'm committing 30 crores. So it is EBITDA in sort of accretion.
Got it. Also, Johari Digital also kind of gives you a better margin business in your overall contribution because the reports say that the consumer business, because it's not ODM, is growing at a fast clip but lower margins. Does it get offset by these forces?
Yeah, Johari Digital has a EBITDA margin of 30% plus.
Right.
And as we scale up that business, and as I shared with all the analysts and the press in my last call, what we have acquired is not a business. We have acquired a platform or a launch pad. And it's currently a 150 odd crore of business with about 30% EBITDA margin, 32% EBITDA margins. What we believe is that we have truly got a launch pad. And honestly, it will be my failing as a manager if I'm not able to capitalize on this.
Got it.
So in the coming 3-4 years, we believe that this can be significantly scaled up without compromising marginal this way, that way, the margin is there, but not coming down to a below 20% EBITDA margin on this.
Sure,
so
got it.
Margin at about 30%, we can significantly scale it up. So that will help me in sort of maintaining or going closer to my targeted EBITDA margin.
Got it. But anyways, I mean, I dwell too much on margins. I'm sure you dwell on business a lot more. I'm just trying to understand one thing. Is there a completely new set of large clients which are coming on the export side to you? And part two of my question, coupled with that and the domestic growth, for how long is this runway of close to 50% growth or CAGR open for you?
On the first question, the new clients which we have onboarded, when we talk to them, they say, look, we have an electronic spend of 5 billion. So you can calculate your thing, what is the run rate you can achieve. They are big clients. We are very confident that with our delivery systems being in place, we should be able to capitalize on the revenue stream which these clients offer. But it will be premature to expect that a client as big as, I would not name them, a multi-billion-dollar American company would immediately put all its eggs in one basket. I have to prove my credentials, which I'm very confident of proving. And then it's only a question of time before the real incremental revenues come in. So for example, the client which you have got will project a revenue of 200 crores next year. But if I'm able to deliver that 150, 200 crores revenue on time and up to his expectation, then the floodgates or sort of it opens up to multiply that 200.
Sure.
Now, the second question, the global run rate of 50% growth rate, we have been growing at this rate. And I personally believe that at least for the next 8 quarters, 2 years, this rate of 40, 50, 35, 40, 50% would be available. A laggard would grow at about 25% or 20. And so I think the tailwinds are simply too strong. And it is for us in the industry to goof up the situation.
Got it. Mr. Gujral, we're speaking for the first time. It was a pleasure talking to you. I do hope between now and the next quarter, we can do a slightly longer conversation to understand the mind of the man behind this business. Thank you so much for taking the time out today.
It's not the man, it's a team behind the business.
Lovely
I'm just a cog in the wheel.
I'm
just a cog in the wheel. I'm just a cog in the wheel.
Lovely talking to you. Thank you so much.
Pleasure is mine.
And viewers, thanks for tuning in.